take a minute and introduce Linda Fabian from LifeSecure. Linda's going to sort of set the stage for the presentation that Sue will be doing here this morning. So Linda, go ahead and take it away.
Well, thanks, Mike. Thanks for having us. Good morning, everyone. Thanks for your interest in LifeSecure. Again, my name is Linda Fabian. I'm the Director of National Accounts with LifeSecure. And with me today is Sue Root, who is one of our multi-life specialists within our organization. And we'd like to today give you a good rundown on our new LifeSecure 2.0 product, as we like to call it, which has just been launched in February, at the beginning of the month here, and talk about some of the specifics as it relates to that. But what I wanted to do first, before I hand this over to Sue, is just give you a little bit of a backdrop on LifeSecure. You may or may not be familiar with us, and we're not quite that household name yet, but I wanted to give you at least the framework of who we are, so you are familiar with us and that you're comfortable in talking about LifeSecure with your customers. I want you to know that we are a Blue Cross Blue Shield of Michigan company. We're a wholly owned subsidiary. Blue Cross of Michigan, by the way, is an A- rated company. We hang on their coattails for a rating at this point. Blue Cross of Michigan is the single largest single-state Blue Cross plan in the nation. They're a Fortune 150 company. And they decided a handful of years ago that they wanted a nationwide presence, and they wanted to adopt some additional products to their suite of health products that they offered. And they decided to get into a couple of different lines of business, dental, workers' comp, and back in 2006, they decided to get into the long-term care business. So it's been very successful for them. You know, back in 2006, it was hard to get started. If you're familiar with the long-term care industry back then, there were an awful lot of providers and carriers at that point. But we've had a nice progression to where we are today that we'll be telling you about during this conference call. But in addition to long-term care, Blue Cross decided to expand it into a couple other ancillary product lines, which are written on LifeSecure paper, and those are hospital recovery and accident. And because we've had such a high degree of success, Blue Cross is, again, extremely committed to growing the LifeSecure business. We're moving into a couple of additional product lines later this year and into next that will include disability insurance and even a life component. So with that said, I'm trying to express to you that Blue Cross is certainly very committed to LifeSecure and the growth of our business. You know, back in 2006, when we got into the long-term care business, as I already mentioned, there were an awful lot of carriers there, but we decided to approach it very differently and with a real blank sheet of paper approach. We recognized that long-term care had gotten to be a very complicated product. So what we decided to do was really move to a very simple product with just a couple of touch points. Bucket of money, how do you want it distributed, and do you want inflation protection on there? So just a couple of things. And with our new product that Sue's going to be talking about, we've stuck to the core. We've maintained the fact that a simple product works best for us in both the individual market as well as the multi-life market. And we decided early on, again back in 2006, that what was important is to approach long-term care differently than the other carriers and really go into a paperless environment. High technology company is what you'll see LifeSecure is. And it really gets us a lot of different things, including very quick turnaround time that we really pride ourselves on. So those are a couple of different things that we looked at back in 2006, and our timing was right back then. You know, the interest rate environment was already low, so we priced our product accordingly. We have that going for us. We've never had an unlimited policy, so we can completely put our arms around our risk at LifeSecure. And we, of course, have no legacy business. You know, we started out with, back in 2006, if you would have looked at us then, you would have said, oh boy, they're really expensive. I've never heard of them. Why would I sell their product? So we've moved into something that we have to tell you about today that should be very attention-getting and very well received by your clients. I wanted to share with you the Blue Cross commitment, and I hope I've done so by those few bullet points. We have tremendous staying power in this business, and that will be, again, acknowledged by something that will be coming out here very shortly, and that's a guarantee letter that actually already has been written and authored by Blue Cross. And you'll be able to share that letter with your customers up and coming, and I'm hopeful that that'll happen before the end of the first quarter. If not, it'll be the second quarter. But what that letter does state is that Blue Cross is the 100% guarantor of our business, 100% guarantor of our reserves, 100% guarantor of our claims, and, you know, again, very strong and front and center in terms of Blue Cross, a $21 billion enterprise, having complete confidence in LifeSecure as we move forward. So, should you have any customers, be it group customers or individual, that want any additional information, certainly we're available to visit with you on the commitment that Blue Cross has. Certainly the good folks at AIM are willing to visit with you on that as well. But again, as backdrop, I wanted to give you a couple of those bullet points. We're excited about this new product that we've just launched. We're one of the companies that have had the longest fire sale in history. We just got done with that over the last 3-month period and switched over to our new 2.0 product the first week of February. Because we've had such a long fire sale and because we're such a high technology company, I'm here to tell you that even though we've had a tremendous amount of business brought into us during the month of January, we're really very much on point with turnaround time, because so much of it does happen from a technology basis. A lot of things don't have to be physically touched. With the LifeSecure process, we really are just a few days beyond where we were in December in terms of a turnaround time. So should you have used us during the month of January, you really won't see much difference in your turnaround time because we are very much on top of it. So very pleased about that, and pleased to give you a fresh look at what LifeSecure 2.0 looks like. So with that, let me pass it to Sue, who has a PowerPoint that she'll go over with you, and also we'll field your questions as we get through this. So again, thank you for your attendance in this morning's webinar, and thank you for your interest in LifeSecure. With that, Sue, take us through the webinar, please.
Welcome, everyone, and I want to thank Mike and Linda. LifeSecure's new product in 40 states, possibly coming up to 43 states, has a new option. It's called the Shareability option. And this new product was brought in on February 3rd when we had our new rollout. So when we brought this product out, this particular rider that was added to our product was available and still is available on the California product. I'm not sure how many of you on the call today deal with California, but this rider, the Shareability option, was on the California product. And so when they rolled out the new product, they decided to add it to the other states. So it's a really nice option for your clients. And what it offers is each client will have their own benefit bank, and they have the flexibility of, if they should use up all of their benefit bank, if one spouse would use up all of their benefit bank, they have the option when they buy the Shareability option to dip into their partner or spouse's benefit bank. One part of the benefit bank is that, one part of this rider is that you must leave 12 months worth of benefit in the second spouse's policy. So the other thing that's been added is international coverage. And the, excuse me, the international coverage that has been added to the product also is not available in California because the California product has not changed, is 100% of the monthly benefit for facility care internationally, 50% of the monthly benefit for home or community care. The waiver premium does not trigger when you're using your international benefits. And the other option is that it only is good for 365 days. So should you have benefit left in your benefit bank, you could come back to the United States and use the rest of that benefit. The shared care, as you can see here, the shared care benefit, or the shareability option, as it's being called, is a benefit bank that you cannot buy. Each spouse could not buy more than a $750,000 benefit bank. And what this slide is showing you is what the cost of that rider is. As you can see, the cost of that rider is very small. If they buy let's use for an example, they buy a $750,000 benefit bank for each spouse, the cost of that rider is 3%. So as you can see, it's a great benefit, and several of our agents out there are having great success in selling this particular benefit. What this slide is going to show you is what the original product, what we call our LTC 1.0, and what our new product, LTC 2.0, the differences between them. What we had before was we went from the ages of 18 to 84. We currently now go from the ages of 18 to 79. The benefit bank has changed. We were at 75,000 to 1 million. We've now changed that to 100,000 to 1 million. The monthly benefit is still 1, 2, or 3%, chosen at the time of application. And as you can see by my screen here, they're showing you an example of someone buying a $300,000 benefit bank at 2%, which means their monthly benefit would be $6,000. And the client can then add, the policy comes with a guaranteed future purchase option. The client has a choice of adding 3 or 5% compound to their policy at the time of application. The coverage, it has home care, it's got assisted living, nursing home, and hospice care. We only offer a 90 calendar day elimination period, and the waiver of premium kicks in once you have satisfied those 90 days. And because it's a calendar day, it starts on day 1, 90 days later, whether you've had formal services or not, your elimination period will be satisfied. Bed reservation is unlimited during the year, and it's for any reason. We also have what's called a flexible benefit. Now, this is not available in California, but it is available in the other states. And what the flexible benefit is, it's 50% of your monthly benefit that you can take in cash. And it works 2 ways. You can either take the cash and not be reimbursed for any bills, or should you be reimbursed for some bills, you would be allowed to take 50% of the cash that's left in your monthly benefit. And this here is showing that in the older product we did not have the international coverage, and in the new product here in the sort of brownish color, it's showing that we do have it now. So we had 3 payment options before. That was lifetime, a 10-year, or paid up at 65. We have stopped using the paid up at 65 basically because no one was buying it. They're more interested in a 10-pay or lifetime pay. Our care options are provided in various settings, and it's according to whatever your plan of care is. The cost may be reimbursed. You may be reimbursed on your full monthly benefit is in your home, in an assisted living facility, a nursing facility, or adult daycare. Again, it talks about the informal care being reimbursed to 50% of your unused monthly benefit under that flexible spending. I don't know, Mike, do you have any questions?
No, there was a question about California at the beginning, but right when I was getting ready to pop in there, you went ahead and transitioned right into it and covered it. So we're good so far.
Great, great. California, rare bird that they have the shared care, they have the 10-pay, but they do not have the flexible spending. And I don't have any answers to when they may be getting that. It's California just seems to take their time in approving things, and that goes along with any carrier that's out there. So again, I'm going to talk about our waiting period being 90 days. You don't have to have proof of receiving paid benefits. And once you've satisfied your elimination period, you only need to do it once in a lifetime. So once it's satisfied, should you come off claim and begin paying your premiums again, and let's say a year later you go back on claim, you would not need to satisfy another 90 days. I talked about the guaranteed future purchase offer that comes with the policy. It's not additional. It's built into your benefit. And what it is on the anniversary date of your policy, on the third anniversary date of your policy, and every 3 years thereafter, you will be offered a 15% increase. It doesn't matter if you decline it 3 times in a row. There's no limit on those, and it will go up to the age of 80 or until you're on claim. Waiver of premium, it kicks in once you've satisfied your elimination period. Again, there's more information here on the international coverage. We do have a care advisory service that can be used. It can help you about questions on long-term care, recommendations for care facility, arrangements for personal care, or services in your area. It's not any additional cost. It's built into your policy. This talks a little bit more about your flexible benefit, and I believe I have a slide here. Let me look really quick that explains this. If your client has a $5,000 monthly benefit and they don't use any benefit that month, at the end of the month they have $5,000. They can take half of that, 50% of that, in cash. They can use it to pay a family member. We aren't going to ask them how they're going to spend it. If their client has a $5,000 monthly benefit bank and they submit bills for $2,000 of that, they have $3,000 left, they could take $1,500 or 50% of the $3,000 in flexible spending, and they could have that in cash to use it how they wish. I don't know if it's pretty simple. Clients really like this. It gives them the best of both worlds. They could still be reimbursed for benefits, and then they could also receive the cash should they need it for other items. And that happens on the same month. So I believe that it's just a wonderful benefit. So now we're going to talk about some of the riders that are available. And in our new product and our old product, the policy, as I said, came with GFPO, Guaranteed Future Purchase Option, and the client has the ability to purchase either 3% compound or 5% compound inflation rider with their policy. In the new product, you can purchase the shared care rider. We talked about how minimal the cost is for that rider to be added to your policy. We also offer a money-back promise rider, and this has been, the policy needs to be enforced for at least 5 or more years, and you would receive a percentage of the premium back less any claims that have been refunded. So this sort of tells you if you're in policy year 5 to 9, you would get 25% of the premiums paid upon death, and that will be paid to a named beneficiary. If you're in years 10 to 14, they would get back 50%, and years 15 and beyond, they get back 75%, minus any claims paid. We have a non-forfeiture benefit rider, and the policy must be enforced at least 3 years, and this would then, if you stopped paying for your policy, it would refund your premiums paid at a reduced rate. It would give you benefit equal to, how do I explain this? It gives you benefit according to the premium that you paid in. So let's say your client paid, they're in year 7, they paid in $10,000 in premium. That $10,000 would become their benefit, and it would be put out the same way as they had set up their policy. So if they had a 1% at a $100,000 benefit bank at 1%, meaning their benefit would be $1,000 a month, that's how this benefit would be paid out. Non-forfeiture sometimes can be tricky. Does anybody have any questions on that?
Actually, we have a clarification question on elimination period, which is that if it's been exhausted in home care, does that take care of elimination period for a facility?
Yes. Yes, it does. It's a 90 calendar day elimination period, whether you are in facility or whether you are at home.
Okay. And then cover real quick for us, Sue, the transition, the handoff, in the event that spouse A passes away, the transition of remaining benefits to spouse B?
If they have purchased the shared care, and I think that might be in here, but if they have purchased the shared care rider, first of all, their benefits have to be identical. So if spouse A buys a $500,000 policy, spouse B must also buy a $500,000 policy, both with shared care at the same time. So, and the inflation, everything has to match on it.
Right.
So spouse A has used up, let's say, half of his benefit, and he passes away, or she passes away. The rest of the benefit for spouse A will be given to spouse B, and spouse B no longer has to pay for the rider for the shared care.
Okay, that's concise and clear. Thank you. That's perfect. Thank you.
Okay. Now we're talking about, again, they're talking about in my slides, and I can send you this, Mike, if you want to send this out to anybody that wants to look at this.
That'd be great. I always get requests, so yeah.
Okay. Talked about the compound benefit, 3% or 5%. It's effective on the anniversary of your policy. And it happens even while you're receiving benefits, so even while you're on claim. The money-back promise, the policy needs to be in force at least 5 years, and then a percentage of the premium less any benefits paid is refunded to the beneficiary. The non-forfeiture rider has to be in force 3 years, and whatever is the amount of premium paid in will be your benefit. So it's, you get reduced coverage, but that's what. But at least we don't have very many people buying this option. They're more interested in the money-back promise and adding compound inflation to their policy, or the shared care. Shared care is very large. So again, here's another slide on shared care that just talks about how the benefits have to match. In this case, they bought a $250,000 benefit bank at a 2%, and Alex has used all of his up, and Kim must have $60,000 left in hers for 12 months of her monthly benefit. And with shared care, you can't buy a benefit bank larger than $750,000. So they both could have a very nice benefit at 1%, with the shared care only costing them, the rider itself only costing 3% under a 1% monthly benefit bank. So this is, you know, with both of our plans, the care advisory and the services are the same. The caregiver support services are the same. They haven't changed anything there. What they did change was on the limited pay choices, they had a 10 pay and a paid to 65 before, and now they just have a 10 pay. What has changed outside of California is that prior to our new product, there was a 10% spousal discount if only both applied and one was approved, or if just one applied, it was called a married discount. With the new product, we are not offering those two options. These two discounts here are not being offered in our new product. With the spousal discounts, both spouses must apply on the same policy form, meaning if they're buying an individual, both must apply on individual applications. If they're applying in the multi-life arena, they both must be on multi-life applications. So we can't combine someone applying individually with someone applying in the multi-life arena. With we have a 5% employer discount for groups of 10 or more. We still do offer in the multi-life smaller 3 to 9 groups, but they do not receive the 5% employer contribution discount. This is the rate classes, preferred, standard, and substandard. And here are the cost, the way the cost breakdown is. It's preferred is 90% of standard, standard is standard, and it is gender-based now. And substandard is 140% of standard. So with the multi-life, there are unisex rates on a multi-life pricing. And this is what our new multi-life program looks like. Don't know if many of you are selling multi-life, but it seems to be going very well. Employers are really happy with being able to offer this to their employees. So as you can see on the screen here, the 3 to 9 lives on the eligible employees is the key here. 3 to 9 lives. The employer must purchase 100% of the plan. Now, it's a defined plan. They can purchase anything from $100,000 to $300,000 in this blue column here, the blue screen, defined advantage plan. It's for your small groups. What's changed is the employer must now buy a Cadillac for everyone or a Chevy for everyone. He can't buy a Cadillac for himself and 2 Chevys for the other 2 employees. The other thing that's offered is we have to have 5 applications, 5 approved applications in the defined advantage. So that could be 4 employees and 1 spouse, 3 employees and 1 spouse, 5 employees, and they would go simplified issue. The ages now have changed with our new product. We used to go to age 68. It's now age 18 to 65. We still have the same enrollment period, which is 90 days. And the plan that this first column can use is anywhere from $100,000 to a $300,000 benefit bank. Should the employer want to offer shared care, the largest benefit bank you can buy is $200,000. Any deviation from what the employer offers will cause the applicant to go through full underwriting, and they will not get to simplified underwriting. Any questions, Mike? Because that's kind of sometimes a little confusing.
No, we're cruising right along, it looks like.
Okay, perfect. So eligible employees are employees that are receiving the contribution and actively at work. We have a new requirement, and that will be to prove that they're actively at work. The spouses would get simplified underwriting in this case, provided that they purchase the same benefit as the employer is offering to his employees, and that they are actively at work at least 20 hours a week. And they will need to submit that proof with the application. There is no, as you can see here, there is no 5% employer contribution discount except for California. California gets to keep their 5% discount currently. The rate class is multi-life, and the spouses can, if 2 spouses apply in this, they could get the 30% spousal discount. So in our larger groups, 10 to 74, 75 to 499, and 500 plus, they can get they're required to have 10 submitted applications in these first two columns, 10 to 74 and 75 to 499. And the 10 to 74 can go voluntary without a contribution from the employer, but they will go through full underwriting. Groups of 75 or more can have a voluntary offering and receive simplified issue. So some of the things that haven't changed, we still, with those groups as well, we still have the 90-day enrollment period. The age is still the same. What changes for this group is they now could buy a $400,000 benefit bank and receive simplified issue. If they're going to buy shared care, their benefit bank for these size groups cannot be bigger than $300,000. When in your group of 10 to 74, the employer can purchase with an employer contribution. They can pay for the 100% of what of a defined plan. The employer could say, okay, I'm going to offer everybody $100,000 at 3%, no inflation, extra inflation riders, and that would be considered a defined plan. They would all get simplified underwriting. They would also receive a 5% employer-sponsored discount. They also can either contribute to the premium, which is $25 or 25%, and as the minimum, the employer can make any contribution he wants, anything above that. He could pay 50% if he wanted to, or he could pay $50. It would be his choice. And when there's an employer contribution, they receive a 5% employer-sponsored discount. When you bump up into the 500-plus range, then we need 25 submitted applications within the enrollment period. And the spouses need to be, actively at work if the company is going to pay for them. And they would receive simplified issue. So at this time, I think that, are there any questions when it comes to multi-life and the changes that we've made?
Nobody's popped anything up, so I think we're okay.
Okay. So I think that's it for my presentation for today. I mean, we have a quote calculator that's online that's very easy to use. You can also download it and put it on your desktop. And as Linda said, our online application is just awesome.
Yes.
So with that, Mike, I'm going to turn it back to you.
Okay. Well, I unmuted everybody. We're going to see. We'll make a pass through for one more round of questions. Great information, Sue. Thank you so much for making your time available this morning. And folks out there, Sue is right, and Linda was the technology that LifeSecure brings to bear is a huge competitive advantage for you. It streamlines that what can be cumbersome first part of the process, and it's a great advantage for you. So let's see if we got any questions that we haven't already covered on anything that Sue covered this morning. So fire them in here if you got them. Everybody's unmuted, so you can go ahead and talk. Dennis, I know you were looking for some info or asking and kind of poking around on the elimination period. Was there a specific scenario you were looking at or just a general question?
No, just a general question. Thank you.
Okay, great. Okay, anybody else have anything?
My other question regarding the shared care, I didn't quite understand what the percentage of premium referred to in terms of what the surviving spouse receives at death of the other.
They would, let's just say that both of them had policies and they both had shared care, and
yes.
spouse one never used his policy or her policy.
Yes.
His entire benefit would go to her.
Okay, with no extra cost as far as premium goes?
That's correct. And what would happen is his premium would be lowered because they would remove the shared care option rider.
I see. All right.
So if they each had a $500,000 benefit bank and spouse one never used theirs, the surviving spouse would now have $1 million benefit bank.
Got it. Thank you.
You're welcome.
Okay, very good. Any other questions out there pertaining to shared care, the worksite platform, or anything else? Okay, I would say pretty good job, Sue. Again,
Awesome. Thank you very much. I will send you this PowerPoint, and that if someone wants to have it, then you could forward it on to them.
absolutely. Anybody who wants the slides, email me, mike.anderson, and that's S-O-N, at whyim, WHYIM.com. Shoot me in an email. I will get slides out to you once Sue gets them in here. So with that, we're going to go ahead and stop. Thanks to everybody for making your time available here this morning, Sue, especially you and Linda. And we'll look to talk to everybody soon. Thanks.
Take care. Bye.